Good morning. Welcome to Stock Market Today for Thursday, September 3rd, 2020. And I am your host, Dan Russo, the Chief Market Strategist at Chaikin Analytics. Find me on Twitter at DanRusso_CMT. Stock Market Today brought to you today and every day by Chaikin Analytics. Head over to chaikinanalytics.com/today. Sign up for a free email where we get a lot of the content for this show and also give you daily stock ideas to consider that hit your inbox every trading day before the market opens. So U.S. equities pushed higher on Wednesday, ending near the best levels of the day. Utilities, materials, and REITs led the market higher, while energy was the only sector to finish lower on the day. Treasuries were mixed, with the curve flattening. The dollar was stronger on the major crosses, in particular the euro. Gold ended down 1.7%, and WTI crude lost 2.9% as upbeat news on COVID vaccine offset a weak ADP report. Additionally, there were a bunch of Fed speakers out this week reiterating Chairman Powell's view from the Jackson Hole Virtual Summit last week as it relates to being flexible around inflation. As we get to the desk this morning, futures are down 30 basis points, more so on the Nasdaq. That's S&P futures down 30 basis points. Asian equities were mixed overnight. European markets are rallying again this morning. Treasuries are mostly weaker, with the curve steepening. The dollar is stronger on the major crosses. Gold is down 20 basis points. WTI crude is down about 1.5% to kick us off on a Thursday morning. That starts with the S&P further extended to the upside. Now, this rally has played out very much as we've laid the roadmap, and it continues to be a solid rally. No two ways about it. My issue here in the near term is that we appear to be somewhat extended, especially relative to the 200-day moving average. That goes for the S&P, that goes for the Qs. As we pointed out yesterday on the show, small caps are still consolidating, not at record highs yet. But as we think about the S&P, 3,300 to 3,400 is support, 3,250 below that. We are trading at record highs, so there's no price-based resistance. But as I've said, I can make the case for the trend to carry to 3,700. Obviously not going to go there in a straight line, as we do remain overbought in the near term using a 13-period CCI and a 3-day moving average of that indicator. Chaikin money flow is strongly bullish. So the indicators confirm the trend. It's really just a function of respecting the trend, but recognizing when it makes sense to be aggressive and when it makes sense to kind of just sit back and ride the wave. Let your winners take care of themselves and ensure that you have a disciplined risk management process in place, whatever that means for you, right? If that means taking big rallies in stocks like Apple, Tesla, and Zoom and trimming some of your position while moving your stop up on the balance, fine. If that means just moving your stop up and continuing to ride the wave, fine. The point is having a disciplined risk management process and having it in place long before you need to start thinking about it, okay? Should the market roll over and start to head lower, that's not the time to be scrambling and thinking about your risk management. The process should already be there. I am a strong advocate of that, and I think you should be too. Let's look at our market in a minute. What are we writing about in the note today for Chaikin clients? Well, SPY and Qs extend further to the upside. We hit that. Small caps push to the top of the recent range. And I think that's important and interesting because they've been somewhat of an inline performer relative to the SPY. But if we think about if the small caps get in gear and start to make new highs like the rest of the market, that's an added breadth confirmation, right? Breadth does remain strong, but there are still divergences in play. In our note and in what we'll look at in a little while, I'm focusing again on screening for overwrite candidates. We showed you that screen last week. I think it makes sense to revisit it, right? And that's part of respecting the trend. And maybe part of your risk management process is taking these names that you own. They're in solid uptrends, so you don't necessarily want to sell them, but recognize that they may be extended. You can take advantage of jacked up call premium to overwrite on some of your positions. And as we said, futures point to a lower open here today. Taking a look at the industry indices now from a power bar perspective, all still solidly bullish. Dow adds 1.5%, 10-1 bulls to bears. S&P 500 up 1.5%, 162 to 45 bulls to bears there. Nasdaq was actually a small underperformer, not small, was an underperformer on the day by about 50 basis points. 39 to 4 bulls to bears, still solid there. Small caps also underperformed, 698 to 275. Bonds upticked, sending yields lower, and the rally in bonds helped the bond proxies. The utilities have been utterly beat up. So they had a big snapback rally yesterday, up 3%, 5-6 bulls to bears in the utilities. Also note that REITs were one of your leading sectors yesterday as well. According to the Chaikin Power Bar, small cap stocks and large cap stocks remain bullish. So here's the screen, right? We've been talking ad nauseum about favoring growth stocks within the market, and largely that thesis has played out. Largely, if you've favored growth over value, you should be outperforming, especially if you've picked the right names. The trend is still very much up, right? Whether we look at tech, whether we look at the Qs, whether we look at the growth ETFs, the trend is very much up. However, it's extended to the upside. There's no two ways about it. So what I wanted to do, similar to what we did last week, is screen for names that you may or may not own, right? Bullish or very bullish stocks that are outperforming the market. And what I want to see here are the ones that are at or near 1 month highs and above our upper volatility band, right? The upper volatility band straddles the 21-day moving average. So these are just names that have really rallied hard in the near term, still compelling names, but maybe they just have extended themselves. You don't necessarily want to sell them because they're solid trends, but because of this frenzy for growth stocks, we're seeing a phenomenon in the market where call premiums have become bid up. So that could be an opportunity to look at some of these extended names and overwrite positions if you have them, right? Names like CRM and Dell that have really ripped to the upside, Adobe. So, to the extent that you have a position that's large enough that you can overwrite it, these are names that could potentially be candidates for overwriting calls against your existing position to take in some premium and give you a little bit of a buffer against downside. It's very similar. It's exactly the same, actually, as the screen that we showed here last week, but the situation remains in place, so I wanted to revisit it. Let's hit our sector tracker now, the movement of the major sectors over the last 5 days. Materials is our favorite cyclical group, and it's at the top of the list. We continue to like tech, although note that it is extended. Real estate gets a little bit of a pop with that move higher in bonds, as do utilities. Staples also higher. Middle of the road, industrials, financials, and healthcare. And at the bottom of the list, discretionary comms and energy is the only sector that is lower over the past 5 days. It was the only sector that was lower yesterday. So just something to keep in mind. That energy trend just cannot get going, cannot get in gear with the broader market. Hitting our industry in focus, healthcare equipment and services. Healthcare is one of those interesting sectors where I think you have to do the work beyond the sector level, right? There's a difference between services, equipment, pharma, biotech, okay? So the equipment space, XHE, the ticker symbol there, it's been an outperformer over the past 6 months by about 5%. Power bar ratio, very strong, 19 bulls for 6 bears. It's middle of the road, 10 of 21 subsectors we look at, having moved up 6 slots over the past week. So some names there that might be compelling, dig in and do a little bit more work. AngioDynamics, ANGO, Avanos, AVNS, and Hologic, HOLX, all with very bullish Chaikin power gauge ratings. The ETF itself has a neutral rating. Right? You can see that here, 19-6. Strong trend, though, above this rising long-term trend line. In the near term, we're starting to see some relative strength fade. Money flow is still bullish. It's overbought. What I see here is a consolidation after a breakout that's likely to resolve to the upside. The question is it going to outperform? Is it going to go up more than the market? Within this, I think you want to drill down on the 19 names that have bullish ratings if you want exposure to the group. Within healthcare, though, I would argue that you want to be skewing towards equipment and services rather than pharma, and even more recently now, biotech looking like it's starting to roll over. So that's an interesting dynamic at play and speaks to why you don't necessarily stop your analysis at the sector level, and sometimes it makes a lot of sense to drill down. Let's look at what's trending now. Yesterday's movers and shakers are gainers and losers in the S&P 500. DXC got a positive mention on CNBC from a buy-side portfolio manager. Gave a pop to the stock, 11.6%. Brown-Forman, earnings and revenues beat expectations. That stock up 10%. Lam Research, semis had a good day yesterday. LRCX rebounding after being under near-term pressure, up 6.5%. Align, didn't see anything company-specific there to drive that stock higher. I think there was some news on one of their competitors. Maybe that was the case. And then Twitter getting a lot of attention as it breaks out of a consolidation pattern and moves to the upside. I didn't see a lot of company-specific news. It did look technical in nature to me. The loser side of the board has, you can see a common theme here, right? Energy. You can see it. It's there. Energy was the only sector to finish lower on the day. Interestingly, as I drilled down, didn't see anything company specific on any of these names. All right, so Diamondback down 5.6%, APA down 3.5%, EOG, all right, Concho and Devon, all just names within that energy complex that have they've been laggards. The group's been a laggard. You know, it rallied off the lows with the rest of the market, but it's not outperforming, right? So it's tough to get excited about the group. Believe me, I'd love to get excited about the group because it's largely under-owned. And there'd be opportunities there if they do start to get in gear. They're not in gear with a broader market and don't show any signs of getting into gear. So it's really hard to get excited there about the energy complex. Now let's dive in. On Thursdays, we do our breath work rather. So let's talk about two situations. Let's talk about the absolute state of breath, which is strong, right? Percentage of stocks above their 200-day moving average, 67%. Above 60, healthy majority of stocks in long-term uptrends. Percentage of stocks above their 50-day moving average, 83%, right? Healthy majority of stocks in intermediate-term uptrends. If we take it a step further and look at the percentage of stocks above their 20-day moving averages, that is at 78%. It's in my notes, not shown here on the chart. So you have a healthy majority of stocks in uptrends across time frames. All right, so breadth, the absolute breadth situation is definitely positive. Here too, the advanced decline line has worked off its divergence and made a new high with the price in the equity market. The kind of where I kind of throw the caution flag a little bit is the divergences. Not back at levels yet, not exceeding previous highs. So that's a state, right? That's a situation in the market that you just want to be aware of. It's not an immediate sell signal, especially when the breadth metrics are strong. But it's something to be aware of, right? Especially when you connect the dots and you say, well, the market's overbought and somewhat extended in the near term. I like to think of it as a way to calibrate how aggressive you want to be with new ideas. That's kind of how I think about it here. And then you have to wait. You look for a confirmation, right? These are things you need to be aware of such that if the price started to roll over, if the equity market started to roll over, that would then confirm these divergences. So the divergence is not the signal, it's the wake-up call, if you will. That's at least how I think about it, and I also think about it in terms of how do I want to be calibrated from an aggression level? Do I want to be super aggressive when markets are overbought, somewhat extended in the near term, and these divergences in place? Probably not. I probably want to stick with my high conviction ideas and make sure my risk management process is in place. Okay, let's look at, speaking of extended, time for a tech pause. I think the case can be made here. You have this steep uptrend off the March lows, above the 50-day, above the 200-day. No doubt that the trend is strong, right? On an absolute basis, look at the bottom of the chart. The trend is strong on a relative basis as well. But if we take a look in the middle here, we can see the RSI reading about the mid-80s. So you can make the case that we're just overbought here in the near term and maybe due for a pause in the rally, right? Not a breakdown, not a sell everything, a pause in the rally. Certainly not out of the question, and I think it's something we should be paying attention to. And finally, we see a breakout in the ag commodities, DBA. Nice rounded bottom here and taking out this peak from late March, early April, and the 200-day moving average. And interestingly, DBA relative to DBC, the broader commodity complex, starting to outperform. So that'll wrap us up for today. Have a great Thursday, everyone.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.